about the inventory, about the patent, the impairment, and the note receivable and the dividends. So what we have here now is the statements from year 5. And I've left both columns here so you can either do the debits and credits or in the working paper approach, or you can just do the shortcut, which is the direct. So I'm actually be doing the direct. But on Blackboard, there is an Excel spreadsheet. The solution of both this example and the next example, or the second year, year 6. Okay, so there's one thing we'll look at here before we go on. Well, a couple things. So this is where we're going to do the consolidated. Now, this dividend income. Remember we said the dividend paid has to be eliminated. So we want to know, is this all from the sub? Because they could have used, or they could have 2 investments, okay? Now on here you only see 1, okay? But this is something you'll want to check in other examples. So in here it shows the sub paid dividends of $2,500. This is the retained earnings statement. Well, how come this is only 2,000? So if we take 80% times 50, sorry, 2,500, we get 2,000. So that's the parent's dividend. Okay? So yes, all from sub. Okay. Another thing we want to look at, we're going to make sure that this statement is at year end. It's got the investment in, and we're using the cost method. So this is how much we paid, because it hasn't been impaired. The investment hasn't been impaired. Goodwill has, but not the investment. Anything else that I need to just talk about? So here we have the income statement. Here we have the retained earnings, and here we have the balance sheet. So notice we have to do the retained earnings statement. So if they ask for the retained earnings statement, or statement of retained earnings, we will have to calculate the beginning balance. If they don't, then you only need, whoops, sorry, the retained earnings down here, which ends the ending balance. Calculate ending balance. Okay, so in this case we do need the beginning balance, so we're going to have to calculate that. Okay, and I'll just refer you back to page 1. It says calculate beginning and or ending retained earnings as required, and this is consolidated. Okay, so in this case we need beginning, because they're asking for the statement of retained earnings. Okay? So over here, we'll get the beginning, then we'll actually calculate it, then this will go down to retained earnings here. So just before we go on and start doing the other schedules, again going to 1, we've done AD and goodwill. We need to do schedule of change position differential. I see I have 2 schedules written. And then we'll go to the consolidated statements. Okay, so on to page 5. And, oh, actually, before I do, you guys, go back here for a sec. On page 4. And these, number 4, are our intercompany transactions. So when we have transactions between the companies, when we do a consolidated statement, bring them together, we have to eliminate those transactions. Okay? So those intercompany transactions or basic transactions would be number 3. So we can also call them basic transactions. Now let's go on to page 5. So, schedule of changes in AD must now be completed. You need to complete it from the date of acquisition to present date. Now, in this case, it was easy. We started at acquisition, so it's straightforward. Make sure you know what year you're working with. Okay. So, here you list everything from your goodwill calculation, which I'll just pull up in a sec. So, we want everything here, including goodwill, on changes in acquisition differential schedule or table, or these aren't formal, okay? So we have inventory, we have a patent, and we have goodwill. So just like on the acquisition differential calculation, debit's positive, credits are negative. So we need to know the balance on January 1st, year 5, which is acquisition. So 2,000, right from the calculation, debit 12,000, and I'll just put debits here so we remember, and goodwill was 4,000 debit, and they're debits, so they're all positive. So our total is 18,000 debit. Okay, so how did they change in year 5? Well, let's start with the goodwill. What happened to goodwill in year 5? Well, it got impaired. So we've got a $50 impairment from point number 4, and that's going to be a credit because it's going down. Everybody okay with that? Okay, now let's jump up to inventory. I'm going from easiest to more complex. So inventory, what happened to this inventory during year 5? What did the sub do with this inventory that got marked up? It went down. Why? Because it got sold. It went to cost of goods sold. So we're going to have inventory was a debit, now it's a credit of 2,000. So it's a credit and it's going down. Okay? Goodwill's going down. So let's make sure we know what to do with the goodwill, and then we'll do the inventory, then we'll talk about the patent. So that means impairment expense has to go up. Because think entry. We credit goodwill, and what do we debit? Impairment expense. Okay? Now let's look at inventory. Inventory goes down and disappears Actually, let's go back to goodwill. Let's also write the goodwill. Impairment expense goes up and goodwill's down. And here, inventory goes down to 0 because it's sold. So that's going to be a credit. And that means, what are we going to debit? Cost of goods sold. So cost of goods sold has to increase, which is a debit. Now, finally, and I'll use a different color, what do we have to do to the patent? Go back and look on page 4. Nope, I lied. 3. So, page 3, does it have a life? A definite life? Yes. So, therefore, we have to amortize it. So, how long is its life? 12,000 divided by 8. So it's going to be 1,500. And it's going to go down, so it's a credit. Okay, so that means we just calculate the balances. There's 0 inventory left. Patent went down to 10,500. And goodwill went down to 3,950. Okay, now what are we going to do with the patent? Patent goes down, and patent amortization goes up. So that's our credit, that's our debit. And then we have our balances. So we've got 3,550 and 1,4,450. Okay, so what you're doing is you put the acquisition stuff first from your calculation of goodwill. Then you have the changes, then you have the balance. Okay, so the changes are going to go on the income statement. The balances are going to go on the balance sheet. Okay. Now, it's important that we know, is net income going up or down? So this is all in net income. So if we're increasing impairment, increasing cost of goods sold, and increasing amortization, those are all expenses. So expenses are going to increase. So net income goes down. So that's important to think about. Okay? Now, last thing I want to show you is you could have, one of these could have been a credit, as we've seen in other problems in other chapters when we calculated goodwill. So let's say we have a piece of equipment that was overvalued by 6,000. Okay? And let's say it's got a 6-year life. So how would we do that in this little chart? That would be negative 6,000. So a 6-year life, 6,000 divided by 6 is 1,000. And it's going to be a debit. And what's left on the balance sheet is a credit of 500,000. So this is going to make the equipment sorry, the equipment depreciation go up. Oh. Okay. Think of it this way. Sorry, guys, I had just a blank moment there. So, if this piece of equipment was overvalued, on the subs books, what happens to their calculation for depreciation? Well, on their books, they've got a big piece of equipment. It's big. So their depreciation expense is going to be big. So, should big if it's overvalued? No. So equipment depreciation has to go down because subs, and that's expense, depreciation expense. Subs depreciation expense calculation was too big. Okay? So if the depreciation expense goes down, what's going to happen to net income? It's going to go up. So you notice it's the opposite. When this is negative, net income's going down. When it's positive, net income's going up. So remember way back when we learned how to calculate, and I'm on page, I can't see because I wrote over it, 3. I said this is critical to get right, and make sure you get this right and this right. Double check this schedule also, because this underlies a whole bunch of changes you're going to do in your statement. Okay? Okay. So, 2 from page 1. So we're going to kind of skip these 3 and 4 because they'll become more important in chapter 6. But now we're going to calculate consolidated net income for the year. So I'm just going to draw this down. Calculate consolidated net income for the year. 2 things to remember, or 1 thing. The second thing will be in chapter 6 when we add tax. Income statement is for the year. So if this thing was in year 2, we would only we would ignore year 3 and 4 and just do year 5. And we'll do that in the next example. Okay. So what we do is we start with the parents, okay, and then we adjust it. Then we put the subs net income and adjust it, and then we combine them, and then break it into 2 pieces. And I'll tell you that when we get there. So we're going to start with parents stated net income. Now, this is one of the problems with these questions is they're so long. So where's the parents stated net income for year 5? Well, parent and their net income is $20,300. It's on page 4. Now we've got to take away the stuff from the parents' net income that came from the sub. So we're going to take away less parents' dividend from the sub, which we also have on page 4 as 2,000, where it says dividend income. And that's our adjusted parents' net income. So that's 18,300. Okay. Now we've got to deal with the sub. So We're going to take the parents and then add to the subs to get consolidated. So we take the subs, we're going to add subs net income, and again it's on page 4. It's also on page 2, I think. So sometimes there's multiple sources. Okay, so the subs net income, looking here,